Return on equity is one of the few ratios that ignores the price of the stock. So what does return on equity actually tell us? Return on equity is one of the few ratios that ignores the price of the stock. So what does return on equity actually tell us? Well, it can tell us a lot if we look close enough. And this is where the Dupont analysis comes in. In the Dupont analysis, we break down return on equity. This breakdown helps us see the impact of profit margins, leverage, and turnover on shareholder returns. Let's look a bit closer. The calculation for return on equity, often called ROE for short, is simply net income divided by equity. So this tells us how much profit a company generates for each dollar of equity. So a return on equity of 25% tells us that for every $1 of equity, the company generates 25 cents in profit. But how return on equity is generated can often help add to the story. So essentially, the Dupont analysis is a breakdown of this formula to look closer at how ROE was generated. Here's an example of an income statement and a balance sheet. So if we simply take net income and divide it by the average equity, we see that we get a return on equity of 32%. Now you may notice that we simply use net income and we had to use average equity, not just equity. And that's because net income is the income earned over the entire year, while equity in the balance sheet as a whole is simply a snapshot at a specific point in time, in this case, the end of 2017. So to make the two numbers comparable, we typically use averages on the balance sheet. So we add up the starting number, which is the ending number from last year, to this year's ending number, and we divide by 2. Simple enough. Now let's start breaking this down. If we take net income and divide it by revenue, we get net profit margin. But then we can take revenue and divide it by the average total equity, and this gives us our equity turnover. Net profit margin tells us what percentage of revenue is converted to profit. Equity turnover measures how much revenue the equity is able to generate over the course of the year. But we can go further. We break equity turnover down by adding average total assets. So now we have net profit margin, asset turnover, and a leverage ratio. This allows us to see how the equity turnover was created and how it contributed to overall return on equity. Asset turnover helps us examine how effectively management uses the assets to generate revenue. This leverage ratio shows us how much the company borrows or how leveraged they are. Because don't forget the basic formula of the balance sheet. It's assets equals liabilities plus equity. So if there were no liabilities, well then assets and equity would be the same, and our leverage ratio would be 1. So the more debt the company has, the higher this ratio will be. Now if we stopped right here, this formula was the original version of the Dupont equation, but it was realized that the net profit margin formula can be further deconstructed to give us even more information. Instead of going right from net income to revenue, we can break this into tax burden, which shows us the effects of taxes on profit, interest burden, which shows us the effects of interest expenses, and finally, operating margin, which shows us the percentage of profit from operating the business. Now, if we simply multiply these numbers, we end up with the exact same 32% we calculated to start with. Now we can do the same Dupont decomposition to a competitor in the same industry to analyze not just how return on equity stacks up, but why they're different. We could also compare a company to its own history. Why has ROE changed? Since we have the last few years of numbers here, let's take a look at the changes. So in 2015, ROE was 101%. In 2016, it fell to 73%. In the calculation we already saw, in 2017, it was just 32%. When we look closer, we can see that the tax burden fell, which is negative for ROE. All these percentages here, the closer they are to 100%, the less impact they have on ROE. So the 50%, we can see that taxes took a huge chunk out of earnings before taxes. Then interest burden got slightly worse each year. By the looks of it, it seems that EBIT was falling faster than interest expenses were falling. Then we have operating margin, and that got worse as well, suggesting a less efficient business. Now we can also see that asset turnover is falling, which tells us that $100 in assets, let's say in 2015, produced $72 in revenue. Now it's only producing $65 in revenue. Generally, higher financial leverage leads to a higher return on equity. And this makes sense because if a company had a ton of debt, well, this would lead to smaller equity, which in turn would create a higher return on equity. So we usually want to be careful if we see return on equity improving, but then we notice that it is due to an increase increase in financial leverage. This can be a red flag about the company. So that's an example of the Dupont equation and how we can use a Dupont equation to determine what is happening to return on equity. If you have any questions about the world of investing, any suggestions on videos, please post them